Hey guys, Jay Campbell here with eXp Realty. Look, I want to share some information with you that will hopefully prevent someone out there from making some of the same mistakes that I did while I was serving in the military. You know, look, I moved 12 times in the 15 years that I was in the Marine Corps. And the decisions that I made when I chose where to live every time the military moved me, those decisions ended up costing me $450,000. And yes, unfortunately for me, you heard that correct. $450,000 just based off the decisions that I made about where to live. And we all face those decisions every time we move. Do we rent or do we buy? Do we live on base or do we live off base? Do we have roommates or do we not? You know, Spoiler alert, guys. Long story short, I rented instead of buying. And in this video, I'm going to walk you through every decision that I made and how, if instead I would have bought, at least when it made sense, I'd have $450,000 more in my net worth than I do today. Guys, that is a lot of wealth that I missed out on building for myself, but more importantly, that I missed out on building for my family. And like I said, if this video helps just one person not make that same mistake, then making this video was well worth my time. Now, I can think of a lot of things that I would do with $450,000, but what would you do with $450,000? Comment that below, would you? And look, that $450,000, 100% was based on appreciation, and that shouldn't be. I repeat, appreciation alone should not be your primary strategy for how you're going to build wealth by investing in real estate. Don't get me wrong. It's definitely a bonus, and as you can see, it would have made me a lot of money. But you're not always going to be able to buy a house at market value and then expect to accumulate this kind of wealth within a few years. Relying on appreciation alone to build wealth for yourself is faulty and it's dangerous. That doesn't mean you shouldn't invest. There are several investing strategies that I'm going to briefly discuss in this video, but then in future videos, I'm going to dive deep into each one of them. So if you haven't already subscribed to my YouTube channel or liked my page, do so now so that you get these updates when those videos post. But, for now, let me be clear and honest. The market would have certainly been in my favor over the last 10 years or so, which obviously would have made it a prime time for me to be investing. Take a look at this chart right here. This chart shows the monthly housing price index. And as you can see, coming out of the housing market crash in 2008, the market has been in a pretty strong climb since about 2012. But you have to make sure that the investments that you have can weather storms like that when the home prices pull back or when the market dips. Now, do I think that we're on the verge of some major recession? No, but it is inevitable that at some point home prices are going to pull back. And you want to make sure that you're in a position where you can hold your investments through a storm like that. You don't want to have to panic sell because you didn't set yourself up for success at the beginning of your investment. If you're going to panic sell, you're going to miss the opportunity to watch your assets continue to appreciate when the market recovers. The market always recovers. My first missed opportunity is a great example of this. I would have bought that home, about halfway through the first big pullback in, 2007, 2008. But the market wasn't done pulling back. It continued to drop until 2012. So if I would have sold when I graduated college in December of 2011, I would have sold for a loss. And then I would have missed this major comeback. Hey, bottom line here, don't chase the market. Meaning that, when the market pulls back, don't sell your asset at a lower price because then, you're likely just going to be buying again after the market recovers at an even higher price. So how do you make sure that you can weather the storm? How do you make sure that you're comfortable holding these investments when the market inevitably pulls back? And there's a few key strategies here. So the first method is just to make sure that you have enough equity in the home so that if the home value does drop, you still have some equity. So you have a little bit of built-in cushion. So let's say, you've got a home that's worth $100,000, but you only owe $80,000. If the market drops 10 to 15%, which is a pretty big drop, you'd still have $5,000 to $10,000 worth of equity. There's a few different ways to do this, and we talked about one just a second ago. you could buy the dip when the market pulls back. And admittedly, timing this can be extremely difficult. If you're looking to buy a home when you're moving on orders, it's even more difficult. At this point, you're operating on a fixed timeline. And in that case, kind of regardless of where the market is in its cycle, if you're only willing to buy when the market dips, and if the market isn't in a dip when you move, you're simply just going to miss the opportunity to buy a house at that duty station. The second way to do it, though, is to find distressed properties that are selling below market value. Finding one of these that is in decent shape, that doesn't require a whole lot of repairs, that can also be difficult. But it does happen occasionally, if you're lucky. And especially, if you have the help of a realtor who knows what they're doing and has experience in this space. But lastly, and kind of along the same lines, another way to do it is to find a property. Maybe it's distressed, maybe it's not, but it does need some work. So you jump in, you buy it under market value. You go in, you put some money on it to do some repairs and rehab. And in doing so, you increase the value of the home. Your improvements result in the appreciation of the home. You force the appreciation. These are all ways that you can build equity on the front end of your investments. The second big way to position yourself, and probably my favorite way to position yourself to hold an investment property through a market pullback, is to make sure that the home is going to cash flow on a monthly basis. What do I mean by that? So when you move out, you're going to charge the market rate for rent in your area. You need to know what this number is for your market. You're also going to experience a series of monthly expenses associated with that property. The obvious one is your mortgage payment, including your principal, interest, tax, insurance. But there are other costs, you need to factor in here too. Another fairly obvious one is, property management cost. This is what you're going to pay someone to find and screen tenants for you. Someone who's going to collect the rent from the tenant on a monthly basis and then deposit that money into your account. They're going to be your interface with the tenant. And then they're also going to take care of your property on your behalf. But there are other often overlooked costs, which are, maintenance or vacancy costs. And these costs you're not going to experience every single month, but they are ones that you should be putting some money aside every single month into a reserve account so that when you do have to pay for repairs or when you do go a month or two without tenants, you use money that you've accumulated in those accounts instead of paying out of pocket. There's a lot of content out there that discusses kind of what percentages of your rent that you should be putting into these reserve accounts on a monthly basis. And it's really going to depend on the age of your home, the age of the appliances within it, what your market's like, etc. So now that you understand all of the costs associated with it, and after you subtract all of those from your rent, so after you subtract the mortgage, property management, maintenance, and vacancy cost, from your rent, that's going to be your cash flow. And you should shoot for somewhere of $100, $200 cash flow per month. And if you're bringing in $200 a month on top of all those costs associated with the investment, it's going to make it so much easier for you to hold that investment, even though the property value, may decrease for a short period of time. Let me break down how I lost $450,000. And honestly, that's a pretty conservative number. It could be a lot more. Why do I say that? Well, because in these numbers, I didn't take into consideration any of those strategies that I just discussed. I simply looked at if I were to buy a home at market value with 0% down using my VA loan at every duty station that I was at, again, that made sense at least, and I didn't refinance it ever, what kind of equity would I have in that home today? I did this for a few reasons. The first reason is that it shows kind of the worst case scenario for what kind of equity that I'd have today. These numbers don't assume that I'm some grand negotiator who negotiated a price well under market value, or I was someone who went in and spent thousands of dollars on rehab to force the appreciation of the house. And second, I didn't know any of these strategies back then, so it would have been unreasonable to assume that I could have made it work perfectly. And you likely aren't an expert either. Otherwise, you probably wouldn't be watching this video. But like I said earlier, not using any of these strategies that we've discussed, it's just dangerous. the point here is don't get so scared about understanding these strategies perfectly or employing them perfectly that you never pull the trigger. This shows that even if you don't employ the strategies perfectly or you goon them up completely, you can still end up building wealth for yourself. But lastly, it demonstrates the power of investing in real estate. If you were to combine, one of these investment strategies along with strong growth in the housing market, just imagine what kind of wealth that you could build for yourself and for your family. So, don't let the short-term risk or the lack of education or understanding impact the decisions that you're making today that could ultimately cost you hundreds of thousands of dollars in missed opportunities. The saying goes, don't wait to buy real estate. Buy real estate and wait while you watch your wealth grow and grow and grow over time. And not to mention, you're only going to get smarter and more experienced after each deal. So stop coming up with excuses and just jump right into it. All right, but before I get into the details of how I lost $450,000, let me be clear on how I got these numbers. So a little peek behind the curtain. Or more importantly, let me tell you what I didn't do to come up with these numbers. I didn't search for, the least expensive home that sold at a given location within a certain date range and then compare it now to the most expensive home that's selling on the market today. What I did do was I found a home that was similar to a house that I rented in the same exact area that I rented and sold around the same time that I moved to that location, but then it also sold again here recently. This is the best way for me to paint, an honest picture of what kind of equity that I could expect to have in a home that I bought instead of rented at each of these locations. All right, so let's dig in. I enlisted in the military in 2005. From 2005 to 2008, really didn't make sense for me to be purchasing a home. I was in boot camp, I was going to various schools, I was doing on the job training, I was deploying. Between all of those, I was a single Marine living in the barracks. And that's an important part because I was a single Marine living in the barracks. I wasn't collecting BH, I wasn't collecting a housing allowance. If I was collecting a housing allowance, it might have made sense for me to purchase a home. If I could have found a home that I could have afforded using my VA loan instead, who cares what my age or rank was? Because I was junior in rank, my housing allowance would have been less, so there may have been fewer opportunities within the price range that I could afford. But that doesn't mean I shouldn't look. And if I find one, great. Starting an investment portfolio 18, 19 years old might be one of the best decisions you ever make. But for me, the cards weren't there. It just didn't make sense. So the first time it did make sense for me to buy, though, was in 2008. So that's when I started school at the University of Oklahoma in Norman. I was in Norman from 2008 to 2011, about 3.5 years in total. I could have purchased a home back then for $150,000. Instead, I did what most college students do, and I rented a home for $1,500 a month. I also had roommates for most of my time in college that helped me pay that rent. And, my mortgage payment on that house, 30-year VA loan, 0% down at 6.41% interest rate was the rate back then. That payment would be about $1,200. I still could have had roommates, they'd be helping me pay my mortgage. The only difference is instead of helping me pay rent that was building equity and wealth for someone else, they'd be helping me build equity and wealth for myself. So after I moved out in 2011 and started renting it out full time, I'd probably need to hire a property manager. That would cost me about $150 a month. I'd need to be putting aside about $75 a month for vacancy and another $75 a month for maintenance reserves, which would leave me with negative cash flow of $37 per month. Definitely not ideal. But consider this, I bought that house at market value, 0% down with a relatively high interest rate. I could certainly refinance that interest rate today and reduce my mortgage payment by at least $300. Then I'd be cash flowing well over $200 a month. But, let's just look at what kind of equity I'd have in that house today too. So my payoff on that home would be $124,000. That same house that I looked at that sold in '08 for $150,000 just sold again a couple months ago for $184,000. $60,000 worth of equity. So, that missed opportunity, my first missed opportunity, cost me $60,000. But let's fast forward now. So 2011, 2013, again, really didn't make sense for me to buy. I was back in the barracks attending school in Quantico for most of that time. And then I was in a short term rental for, about 9 months as well. I knew I wasn't going to be there long enough to purchasing a home to make sense. So let's fast forward past that. The next time it made sense was in 2013. At that point, I was stationed in Camp Pendleton, California. I was there for about 3 years. And, I did what most young officers do, and I went in with a few other lieutenants and we rented a house. And I was happy because I was beating the system because I was pocketing about $1,000 a month in my housing allowance. Joke was on me. So instead, I could have purchased a home back then for $300,000. And, I actually looked at the house that Jen and I rented our last year in California. It was built in 2013 and it sold just a couple months ago. Same exact house we lived in. We rented that home for $2,200 a month. Mortgage payment, again, VA loan with 0% down, 4.62 was the rate then, would be about $2,260. Just like in college, I could have had roommates helping me pay that mortgage for at least the first 2 years that I was in that house until Jen and I got married. And then, after I moved out and started renting it out, my property management cost would be around $220 a month. I'd put aside 110 a month for vacancy and another 110 for maintenance reserves, which would leave me with negative cash flow of a whopping $500 a month. Pretty crappy position to be in. But again, hey, I bought that house at market value, fairly high interest rate. I could refinance that one again today and decrease my mortgage payment by another $300. And then I'd be breaking even, but still, I wouldn't be putting aside anything for vacancy or maintenance. So definitely not ideal. You definitely want those factored into your deal, but it still worked out great. Let's look at why. My payoff on that home today would be about $267,000. That same house that I could have bought for $300,000 just sold for $440,000. So that'd be $173,000 worth of equity that I'd have today. Big missed opportunity. Missed opportunity number two cost me $173,000. All right, so after 3 years in Camp Pendleton, I was done watching my hard-earned cash pay someone else's mortgage every month and help them build more wealth for themselves every single month. I decided at that point that everywhere that I went after that, I was going to buy a house. I figured I had at least 6 more moves in the military at that point, and I'd end up, with at least 6 investment properties by the time that I retired, which I thought was great. Well, the Marine Corps came along and said, "You're going to Monterey, California." And I thought, Monterey, California, I can't buy a house in Monterey. It's literally one of the most expensive places in the country to live. And honestly, I didn't even look into it. Jenna was 8 months pregnant when we moved. I was just getting back from a 6-month deployment. And, I just didn't have the mental capacity, the mental bandwidth to look into buying a home at the time. So, we lived in base housing for a year. And then we actually lived in our fifth wheel travel trailer for the last year or so. I was stationed in Monterey for a little over 2 years, 2016 to 2018. And while I don't think that I could have bought in the heart of Monterey, I could have bought, about 15 to 20 minutes outside of Monterey in, a little town called Marina. I could have purchased a home back then for $450,000. Rent in that area for a similar home would be about $2,850. And my mortgage payment on a 30-year VA loan with 0% down at 3.65% was the rate then, would be about $2,660. So after I moved out and started renting it out, my property management cost would be $285 a month. I'd put aside $140 for vacancy, another $140 for maintenance, which would leave me with a negative cash flow of $375 a month. Again, pretty crappy position to be in every month, but just like the other deals, I could refinance today, reducing my mortgage payment by about $150, and I'd be breaking even. Still wouldn't be able to set anything aside for vacancy or maintenance. So not ideal. You want those factored in. But just like the other deals, it would have worked out great. So let's look. My payoff on that home would be $423,000. The same house just sold a couple months ago for $600,000. That's $177,000 of equity in just 4 short years. Missed opportunity number three cost me $177,000. All right, so after leaving Monterey, I had finally kicked myself in the tail long enough. We finally bought a home when we moved here to Quantico a couple of years ago. I purchased this house in 2018 for about $315,000. Rent in this area for a similar house would be about $2,000 a month. Our original mortgage payment before we refinanced on still a VA loan, 0% down, 4% interest rate, was about $1,800. So when we leave here and we started renting it out, our property management costs will be, about $200 a month. Which means I need to set aside $100 a month for vacancy and another $100 a month for maintenance reserves. Now that's going to leave me with a negative cash flow of about $200 a month. Again, pretty crappy position to be in. But just like the other deals, in this one I actually refinanced and reduced my mortgage payment by about $200, and now I'll be breaking even. Not a perfect deal because I'm not bringing in $100 to $200 a month in cash flow, but I'm still building equity. My payoff on this home today is about $310,000, and I could sell it for $350,000. That means I've got $40,000 worth of equity in just 2 years. So in total, if I would have bought a home at every duty station that made sense, I would have more than $450,000 in additional net worth. Guys, that's not chump change. These were all opportunities that I missed to build wealth for myself with no money down and in just 12 short years. Again, it is my hope that someone out there listening, learns from this, but more importantly, that they take action on it. If this sounds like something that you're interested in and you just want to chat about it more, hit me up. I love geeking out about real estate investing. I could do it all day long. And look, I understand there's a lot to unpack in this video. Hey, I appreciate you just sticking with me this far. I've got several other topics that I want to share with you guys soon. We kind of briefly touched on a lot of them, such as like house hacking. This is a method where you essentially, rent out rooms of your home that you're living in to other people so that they kind of help pay your mortgage for you. At a minimum, this kind of reduces your housing cost, but in some cases allows you to live completely for free. Another method is the BRRRR method. This is an acronym. So buy, rehab, rent, refinance, repeat. So in this strategy, you buy a home under market value because it needs some work. You go in, you rehab it, and then you rent it out. Later on, you refinance it now that you've increased the overall value of the home, and you're ideally pulling out any of the cash that you've invested into the property up front and or during the rehab. And this is freeing up all the capital for you to go repeat the process again on another property. Love this strategy. Another strategy is just multifamily investing. So the strategy here is you're using one residential loan, ideally a VA loan with 0% down, to buy multiple rentable units. So that's either like a duplex, a triplex, or a quadplex. And the concept is that you live in one of the units and then you rent out all the other units. It's very similar to house hacking, but with separate units instead of just renting out rooms of your house. Again, best case here, you live completely for free. I truly believe that multifamily investing is one of the best ways for you to scale your rental portfolio and start building wealth for yourself. A couple other topics, that I want to discuss in future videos are, so when do you refinance out of your VA loan into conventional financing? At some point it's going to make sense for you to do this. So when does that happen? When does that make sense? How do you do it? We're going to go over all that in a future video. And then finally, when does it make sense to cash completely out of your investments? And how do you do that? At some point, it may make sense for you to pull the equity out of some or all of your properties and then reinvest it into more real estate. So for example, with $450,000, I could do multiple BRRRRs at once. I could buy more multifamily properties. So in another video, I want to go over when is the right time to do this and what's the best way to do it. Again, hey, thanks so much for sticking with me this far. If you have any questions about any of the content in this video, please don't hesitate to reach out. Like I said, I truly love talking about this stuff. My contact information is below. Again, if you need help finding a realtor in your area who understands investing and specifically working with veterans and active duty military, let me know. I'd love to get you in touch with someone, that I trust, who I know will take care of you and, help you get the most value out of your next investment. If you found, any of this useful, hey, give me a like, subscribe to the channel so you get all the alerts for our future content. But most importantly, if you know someone who's moving right now and getting ready to make a decision that might cost them thousands of dollars in missed opportunities, please share this video with them. They're the exact person I made this video for. Thanks for watching. I'll see you guys next time.